Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are right in the middle of earnings season here in Australia, or we call it reporting season down under for some reason.
Yeah.
But we're getting a flurry of news from companies, big and small, about how they're going. And there's always stuff to talk about.
There is.
Another jam-packed episode as a result.
That's it. We're going to cover off what's going on with the bankers and miners here in Australia, have a chat about why we invest, and then close out with a community question about companies that provide perks for their shareholders.
Yeah, I reckon there's a few surprising ones in there, especially if you love cruises.
I know.
But look, before we get to those segments, I think one segment has captured people's attention more than any other this year. If I just judge by the entries into our Facebook discussion group, people have to say one thing about Equity Mates so we know they're not a bot if they want to jump in.
Yeah.
And let me tell you, the overwhelming number of people have been saying one thing and one thing only, which is, how is Bryce going to turn $500 into $5,000? So, look, we won't do a full update, but just how's it going?
Look, all I want to say, Ren, is one of my positions, Super Micro, which we've spoken about on the show. Everyone's been aware of it. We're actually both on it. I've one-bagged it.
You've doubled your money.
I've doubled my money.
Hey, nice.
It is up 110%.
But you didn't have all of your $500 in it.
Alas, that is the big lesson I'm learning here, which is, well, I already knew the importance of portfolio. I knew the importance of portfolio construction. But given that the full $500 isn't in it, it doesn't mean I've completely doubled $500. But the update is, nonetheless, we've chosen a stock that has done incredibly well over the last 3 weeks.
Balance update?
663.
Oh my God, it's slow going, isn't it?
Total portfolio, just to remind people if you've just joined, I need 23% a month.
Yeah.
In the last 3 weeks, I'm up 36.36. So I'm outpacing.
Yeah. Like, the thing is, if you did 36% in a year as an active manager, like, everyone would be happy.
Yeah.
Yeah. So, we'll keep it in perspective.
But that's not the goal, Ren. I've set a very lofty bar. So stay tuned on our Instagram feed for updates, and of course, join the Facebook discussion group because we could continue chatting about it there. And in a couple of weeks, I'll do a full update on where we're at.
Sounds good. All right. Well, let's get to the news.
News and markets.
All right, Bryce. Well, if I was to ask you, what is the biggest criticism of the Australian share market, what would you say?
Banks and miners, baby.
Full of banks and miners. Well, as we get into earnings season or reporting season, that's what we're going to talk about today. Because I think often the banks and miners are not newsworthy. How much can you talk about banks growing profits by 3% every year? But that's not what they've done this year. Right. So where do you want to start? Mining or banks?
Let's start with the miners, I think.
If we hold on the truism point around investing in Australia, one is, full of banks and miners. Another one would be, what is the one thing Australian investors love more than anything else?
Dividends and franking credits.
Dividends and franking credits. We are a nation that craves income.
Yeah.
And sadly, our mining companies don't have what we need this half.
No, it's bad news because miners are cutting dividends left, right, and centre. The news coming out of earnings season is not good. Let's start with some of the big guys. BHP, it's been their lowest interim dividend in 8 years with profit down 23%. Rio Tinto, it's their lowest dividend in 7 years with profit down 8%. And Santos, they have cut dividends by 41% because their profit down is 14%. Mineral Resources have completely cut their interim dividend with a loss of $807 million. So not good news across the board. The question is why?
Yeah, well, I mean, look, there's always different reasons at different companies. Mineral Resources is having trouble with Chris Ellison and his allegations around tax avoidance. That actually, that's not affecting the underlying business, but they're trying to get some mines up. They're dealing with lower iron ore prices and lithium prices. BHP and Rio Tinto, the story there is both lower iron ore prices as well. Santos has a lower oil price. Natural gas price is actually, it's almost doubled this year, but it's still down from its late 2022 highs. But Santos's story is also about production challenges. They've got a few new operations that they're trying to get online, and so it's a volume game as well as a price game in the case of Santos. But it hasn't been a good half for Aussie miners.
No.
I think really the story for Australia has been we've ridden the back of China's boom, and particularly China's apartment building boom, and that has really slowed down. Chinese demand for Australian iron ore has slowed down because they're not producing as much steel because they don't have as much use for it. Rio, in their update, reported an 11% fall in their realized iron ore prices from the same time a year ago. So I think that's really the story. Obviously, we know that all these commodity players are cyclical, and if you're an investor in some of these companies, you shouldn't expect your dividends or your profits to go just straight from bottom left to top right of the chart. So like this is the cost of doing business if you're investing in a commodity company.
Absolutely. Well, that's the mining part. Obviously, the second part is the banks, Ren, and they've been baffling analysts for years now with their high, eye-watering valuations.
Yeah, Commonwealth Bank, on some metrics, the most expensive bank in the world.
Globally, yeah.
Some may argue also that one of the more high-quality banks in the world, but, you know, like you're paying less per dollar of earnings for JP Morgan than you are for Commonwealth Bank.
Absolutely. But things are starting to come back to earth, though, in terms of the reporting that we're seeing. Westpac quarterly profit down 9%, NAB profit down for the half to the tune of about 1%, and cash earnings down 2%. And Adelaide and Bendigo Bank, their net profit is down 23%, cash earnings down 1%. But Ren, speaking of Commonwealth,
let's just quickly bust that jargon around cash earnings for net profit. So banks have a lot of non-cash charges. So, you know, they've got massive mortgage books and they basically write off percentages of that book each time they report because they're bad debts. And they also have a huge asset side of their balance sheet, some of which gets revalued when they report. So cash earnings is like the cash profit they're making, basically cash flow. And then the profit includes all those non-cash movements in asset prices and bad debts.
Yeah. So down largely across the board, but...
so they're the profit numbers, and as a result, share prices fell. NAB down about 12%, Westpac down about 7%, Adelaide and Bendigo Bank also down double digits. Yeah.
But the jewel in the crown, Commonwealth Bank, they defied the odds. Net profit up 6%, cash earnings up 2%, and they've raised their dividend 5%.
Yeah. It is...
Pays to be the biggest.
It does, and I think it's just a reminder of one of the probably the most important lessons I've learned over the journey of doing equity mates if you want to invest in individual companies or assets.
Thinking that the second is best?
Yeah. It is often... Don't get fooled by the cheaper valuation of second. It is often worth paying up for the higher quality market leader.
Yeah.
And there's a few examples, and we've pulled them out here just to illustrate it. The classic example of this, the Exhibit 1A that you'll point to, is REA Group v Domain. REA Group is the higher quality, always more expensive of the two. It's the market leader. Over the past 5 years, it's up 134%, whereas Domain, over the past 5 years, down 13%.
After all of the property rises that we've had.
Yeah. And so, you know, REA Group, I think, is trading on about 56 times earnings. Domain is trading on about 40 times earnings. So they're both relatively expensive. But people often say, hey, they're this duopoly in a market. Domain looks cheaper, so let's jump on that. But, you know, this lesson that we just keep getting taught is that often the higher quality market leader is more expensive for a reason. But if we look at the banks, same story plays out. So over the past 5 years, CBA, the market leader, up 79%. The other three of the big four, Westpac up 25%, ANZ up 12%, NAB up 32%. So they've all made money, but it's again just like there's like a power law in business where like the biggest company can attract the best people and can spend the most money on developing the best products and on marketing. And so they continue to accrue more customers and more market share at the expense of their smaller rivals.
Yeah.
So I think it doesn't play play out in all cases, obviously. And obviously, like, the story of capitalism is a story of disruption. But in some of these markets, it's just like, you can just see that power law operating.
The only one of the areas where it doesn't play out, Ren, where you have a true market leader, quality company, absolutely light years.
I did look at this one as well.
Front ahead of its rivals is Woolworths and Coles. Woolworths, the gold standard, last 5 years, down 17%.
Yeah, and
Coles, the laggard,
up 20
barely,
something?
up 22%.
Yeah.
There you go.
Yeah, so Coles
Doesn't always stay true.
That is, sometimes the baton gets passed from
The
one
ugly
company
duckling.
to another. And you don't need to just think about this in stocks. I think it applies in other asset classes as well. The classic example is gold and silver. There's this world of silver bulls who say that silver has more use cases than gold, and it should usurp gold as it will do better from here because gold has done so well. But, I had a look at the Global X ETFs. Over the past 10 years, the gold version is up 11% per annum over the past 10 years. The silver one is up 8.5% per annum over the past 10 years. That's just a reminder of it pays to get the best.
Definitely. Well, both of these areas, mining and banks, made up part of our bold predictions.
Yes.
So the Australian banking index is up 2.5% year to date, and the mining index is up 6.5%. I think your prediction was that banks would still perform overall, so they're up. And mine was that mining would outperform banks.
Okay.
So 6 weeks in, we're doing well.
Yeah, neither super bold, but that's okay.
Well, if you want to keep up with all of the headlines beyond just banks and miners, make sure you're subscribed to our daily newsletter where we'll send you a summary of all the important business headlines from around the world. But if you want to listen to those headlines, we also have a new podcast that is available called Headlines by Equity Mates, where in less than 5 minutes, we'll give you those headlines in audio form. So make sure you subscribe to that, and it'll be in your podcast app now. For generations, the technology that has changed the world has been available for us to invest in through the share market. And when you think of it like that, why would you choose not to invest? And Ren?
Love that, Bryce. Love that.
Powerful.
Look, every now and then we want to remind ourselves of why we invest, because there's so many reasons. And there was a story that came across our desk this week that was a real reminder for me of just like the opportunity that we have here. Because as you said, the technology that has changed our lives, changed the world, often is owned by a listed company or is being developed by a listed company that's on the share market that we could benefit from.
Coca-Cola.
Hydration technology.
Yes.
No, but like if you think about the some of the biggest world-changing innovations of the 20th century, you've got the motor car.
Yeah.
Well, Ford was listed.
Yeah.
You've got kitchen appliances and all of that. Well, Westinghouse was listed. The advent of electricity and electric lighting and everything that came from that. Well, General Electric was listed. The telephone, well, you have Bell Telephone Company, founded by Alexander Graham Bell, that got broken up because it was so big and so powerful and investors made so much money. And now part of that broken up company is AT&T. Obviously, like the advent of oil and, the way that as a fuel changed our world. Well, the Standard Oil and all those companies that got split out of that were available for people like us to invest in. Aeroplanes, the Wright brothers. Well, they had a few companies, but the company that is still listed today, Curtiss Wright. Wright being
the Wright brothers, yeah. But that's not all, Ren. If you fast forward to today, the same story is playing out in front of our very own eyes. You've got the PC revolution, Microsoft. You've got the smartphones, Apple. I remember the day they came out at high school. Still kicking myself.
Apple is a stock that was literally staring us in the face. We would literally pull it out of our pocket and stare at it for hours on end. And we didn't buy it.
I know. We're seeing electric vehicles come to market. Tesla is obviously the example there. The proliferation and the game-changing e-commerce industry, Amazon, Shopify, you name it. Obesity drugs, Novo Nordisk, Eli Lilly, and then how can we not look past what is happening right now in front of us with AI, NVIDIA, and plenty of the other stocks we've spoken about. World-changing and life-changing advancements in technology. able for us to invest in.
Yeah. And that's what gets me so excited about this opportunity that we have to invest. And those stories are all really well known. We're well covered. We're not breaking any ground talking about any of those companies here. But what gets me really excited is also those lesser known stories, because there are so many companies that are filled with, pretty amazing people dedicating their lives to certain things. And we have the opportunity to invest in their work and in their passion and, in their commitment to trying to do these things through the share market from the comfort of our couch on our phone.
Yeah.
It is pretty amazing. And there's one story that I saw this week that I think is worth talking about, and it's about the HIV and AIDS miracle.
Okay.
And Gilead Sciences.
Okay.
Heard of the company?
I haven't, no.
Okay. So I think to set the context for this one, we don't, we were born in the 90s.
Yep.
We don't realize how scary the HIV AIDS epidemic was when it first broke through in the 80s.
Well, I mean, we didn't live it, but yeah.
I think of it like the COVID panic. If COVID was killing 10% of people that got it, healthy young people, it was
intense.
So first emerged in 1981, when Gallup first polled Americans about the disease in 1983. 43% of Americans thought it would reach epidemic proportions. So, within 2 years, there was a panic around how bad this would get. In 1987, 1 in 3 people thought employers should be able to fire employees who had AIDS. 21% of Americans said that people with AIDS should be isolated from the rest of society. It was a full-blown moral panic. And it led to this famous ad in Australia.
At first, only gays and IV drug users were being killed by AIDS. But now we know every one of us could be devastated by it. The fact is, over 50,000 men, women, and children now carry the AIDS virus. That in 3 years, nearly 2,000 of us will be dead. That if not stopped, it could kill more Australians than World War II.
So I'll stop it there, Bryce. That was the bit I wanted to get to. In 1987, the Australian government thought that more Australians would die from AIDS than died in World War II.
Wow.
That was how scary it was. In 1988, another Gallup poll, 68% of people said AIDS was the most pressing health issue of the time. This is where the listed company comes into play. Gilead Sciences, listed on the NASDAQ, GILD. It's now a $100 billion pharmaceutical company, but it wasn't back then. But they, along with a number of research institutions and universities, first demonstrated that have you heard of PrEP?
No.
It's a daily drug, like a daily tablet that can stop the transmission of HIV.
Okay.
And it has absolutely changed the way we see the disease. Gilead first demonstrated its anti-HIV properties in 1997. It's remained the standard of care to today. People with HIV or who are in a relationship with people with HIV can take a pill every day called Truvada, and it's a pre-exposure prophylaxis, or PrEP. It's 99% effective in blocking HIV infections. Miracle drug when you think about how scary the 80s was. To today, from 97 to today, Gilead's up 11,000%.
Nice.
So people would have 100 times their money if they had invested in that innovation. But that isn't why I want to talk about it today, because news broke this week that Gilead have made another breakthrough. So right now, the standard of care is a once-a-day pill, and there's heaps of problem with compliance to that. Like, people forget to take the pill, or there's stigma around the pill, particularly in Africa where AIDS is still just prevalent. But Gilead, they're currently under FDA review for a twice-a-year injectable.
Nice.
So go from a daily pill to twice-a-year injectable. This drug is such a breakthrough that the journal Science named it the 2024 Breakthrough Drug of the Year and they said it was a pivotal step towards diminishing HIV/AIDS as a global health crisis. And for me, I just read that and I was just reminded of like the opportunity that we have and just like how amazing it is, like what some of these companies are developing. You know, when we invest, we're not just buying something with the hope that someone will pay more for the same thing in the future. Like you're investing in a company, you're backing human ingenuity in the capitalist system to create new things and new breakthroughs and new possibilities. It's that these drugs are the culminations of millions or thousands of people's life work. And when they benefit, you benefit as a shareholder. And, you know, be it Ford or Westinghouse or Nvidia or Gilead Sciences, like that's the opportunity that we have as investors. And like, it's pretty amazing that we get this, and it's pretty exciting, I think.
Very exciting. The issue is we just don't have enough cash to put into it all. I'm just looking at it. So I'm guessing sort of midway through last year was when the results came out, or they sort of announced this, 2024. So from that point, clear inflection point for the stock price, up 70% from sort of June last year. So market obviously reacting pretty well to the news. And that's on top of an 11,000% return since 1992.
And like, obviously not a buy, hold, or sell. Like, I don't know enough about their stable of drugs.
No.
I don't even know about the unit economics of this drug. But it's just, I don't know. It's just, I think it's amazing some of the stuff that we are living through. Obviously on a consumer side, like AI and all that stuff. But like the health story, we may look back at the 2020s and say, you know, like the obesity drugs and like some of the like, you know, targeted cancer treatments and some of this other stuff. Like
that. The targeted cancer is wild.
And like all these companies, we've had the opportunity and we still have the opportunity to invest in, like Clarity and Telix and all those. Like in those cases, Aussie companies doing the damn thing.
Well, if that doesn't get you excited to invest, then I don't know what will.
Hopefully this podcast.
Yes.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Question answered.
Did you know that some companies give their shareholders extra perks? Well, open your brokerage app because there is a chance you might own one. And Ren, this is a question that has come in from Jacqueline.
Yeah, she asked, I'd love to hear an episode on stocks with perks and whether any of these are actually worth it. Now, I'm not sure if we've done much content on this before. So for people whose ears have pricked up at stocks with perks, it's not just a financial return that some companies give you.
No.
They may give their shareholders a little extra something to keep them engaged, to keep them on the journey. So we're going to talk, we've got a list from the US.
Yep.
We've also got a list from Australia. But yeah, as Bryce said, keep your brokerage app handy because you might need to contact some of these companies and get back paid for your cruise credits or your freeze chocolates or your discounts. Because yeah, there's some decent perks here.
There are. Well, let's start with the US and start with a very clear thematic, which is cruise liners giving their shareholders perks.
Yes.
We've got Carnival Corporation, Royal Caribbean Cruises, and Norwegian Cruise Line Holdings all offering onboard credits for their cruises if you're a shareholder. I don't have the details on the amount of shares that you need to get access to that, but there is some sort of incentive for cruise line shareholders.
Yeah. So I think there's a bucket of perks that we can run through pretty quickly, which are discounts.
Yeah.
So Intercontinental Hotels, they offer booking discounts. Williamette Valley Vineyards, can't say I know that one, but they offer discounted wine purchases. They also offer VIP tours and special events.
Yeah.
That's not bad. I wouldn't mind being able to get the VIP tour.
Yes.
Yeah.
Not bad.
AMC Entertainment, exclusive promotions and discounts. Aterian, they also offer discounts and they sometimes have investor exclusive offers. I actually don't know what Aterian does. And Online Vacation Center Holdings, they offer 5% cashback on cruises.
Yeah.
That's not bad. Like cruises, I imagine, are pretty expensive.
Yeah. Again, it probably depends on how many stocks you have to own to be eligible, because there are eligibility around all of this.
But look, there are a few more exciting perks, I would say, than just the straight up cashback discounts.
So there's 3M, stationery and the like.
Yeah,
they give an
Post-it notes.
Post-it notes,
Sticky
yes.
tape.
They give an annual holiday gift box with 3M products.
Nice.
That could be pretty good. A few Post-it notes and sticky tape.
True. Yeah. Well, I mean, we buy that. Well, not sticky tape, but we buy that stuff here. Maybe the company should own some.
Lindt chocolate, Lindt and Sprungli. They have a free chocolate box for shareholders attending the annual meeting.
Yeah.
I think that's a bit of a
The
stitch up.
cost of attending the annual meeting, you probably just go to Coles and buy some Lindt.
Yeah, it's kind of also like all of these others are like no strings attached. You're a shareholder, you get access. This is like you're a shareholder, but you also have to come to our annual meeting. It's
Good
like,
way to get people to the annual meeting.
It's like, come on.
Yeah. And then LVMH, they have, so for people who are unfamiliar, Moet Hennessy, Louis Vuitton, the luxury giant, they give investors access to a special wine selection. They also publish an investor-only magazine through their Shareholders Club. So if you want to get some exclusive wines, LVMH.
There you go.
Again, there will be a minimum share parcel requirement, I imagine.
Yeah, so I'm just looking at the 3M because I was like, what's in it? It's actually a bit of a stitch up. You have to buy it. It's $35, but they say the value is $80.
Oh, that's not that good. What's in it?
Scotch gift wrap tape, multi-purpose scissors, washi tape for personalization, and other assorted 3M products, supplies, adhesives, cleaning tools.
Yeah, not quite as good.
You could just go to there and buy it.
You could go to Officeworks.
Yeah.
Yeah. Not quite as good as the Louis Vuitton wine.
No, that's good. Yeah.
But look, let's come to Australia, because I reckon some of the Australian perks are better. I reckon, this is probably one of my favorite ones. Viva Leisure.
Yeah.
They're like Club Lime gyms. They've got a few gym brands. They offer a 25% discount on health club memberships for shareholders owning at least 1,000 shares.
So then the question, Ren, is it worth it? So the share price is currently $1.42.
Yeah, so 1,000 shares, $1,400.
$1,400. Their gym memberships are roughly, for metro gyms, about $1,190 a year.
Yeah.
And then you get a 25% discount on that. So I think I worked it out. You get about $850 gym membership.
Yeah.
So in my eyes, it's worth it if you already hold the stock. But if you go out and buy $1,000 worth of it to get the 25% discount, it's cheaper to just buy the gym membership.
I'm going to say that's the case with all of these.
Definitely.
I think it would be pretty bad corporate management if they gave an offer that made it worth it for people to buy the stock
and get the
to
discount.
just get the offer. Yeah.
But you also got to consider that the Viva Leisure stock itself has been a pretty poor performer. So you've got to keep that in mind. Yeah, down 8% last 12 months, down almost 50% across the last 5 years.
Well, to be fair, up 34% since it listed in 2019.
Hasn't outperformed the market.
But then you add the compounded returns of
your gym membership.
Yeah.
But yeah, I agree. It's pretty. If you're a shareholder, it's pretty good. 25% off all their gym memberships.
I think the point is, like, if you own Viva Leisure,
definitely,
most people who own Viva Leisure probably own more than $1,400 worth of the stock. So go and get your discount.
Yeah. What else is here in Australia?
So EVT, they provide a shareholders benefit card for investors with more than 500 shares, offering things like discounted movie tickets, 15% off hotel room rates, 20% off hotel food and beverages. Now, Bryce, you might be thinking, EVT, I've never heard of them. Well, I actually think you have. They own Event Cinemas.
Oh, yeah.
Heard of it?
Yeah.
They own Thredbo.
Oh, no way.
Heard of it?
They just own Thredbo.
Well, like the ski resorts. They own a bunch of ski resorts.
Yes, I've heard of Thredbo.
They own hotels including Ridges.
Oh, yeah.
QT. So EVT, not bad. Currently trading at about $12 a share. You need 500 shares, so you need $6,000 in shares. So that's a lot of discounted movie tickets to make that money back.
That is. A couple of others. We've got Mosaic Brands. So they own brands like Rockman's, Nonny B, Katie's. They if you have 2,000 shares, you can get 10% discount on purchases from all of those retail brands.
Yeah, you probably don't want to own Mosaic Brands shares though, because they're literally going through bankruptcy right now.
Okay, well, yeah, you definitely don't want that. Beacon Lighting, they offer shareholders with at least 500 shares access to tradie discounts and free delivery on all their orders.
Okay.
Not bad. Cedar Woods Properties, they provide a 5% discount on single residential land blocks and a 2.5% discount on new houses, townhouses, and apartments in their projects. That's pretty decent.
That's not bad.
That's pretty decent.
That's not bad.
I'm sure you have to own a fair chunk of stock to be eligible for that.
And where are Cedar Woods Properties building their properties?
True.
Still, Aussies love
That's not bad. An immediate
housing.
5% discount on a single residential land block could be quite appealing.
Yeah.
AMP, they run a shareholder discount program offering home loan discounts and fee waivers.
Geez, imagine if you were an AMP shareholder and a Cedar Woods property shareholder.
Double whammy.
You'd be getting the double whammy. Although, whenever we go to a mortgage broker, AMP rarely come in with the most competitive offer.
I know. Yeah.
So there's that. Now, this is one that's particularly exciting, but I don't think it's live currently.
No.
But Domino's Pizza in the past have offered discounts to shareholders. You know, there was one time there where there was like a 30% discount for shareholders.
Yeah.
That's pretty good.
That's pretty juicy.
Yeah.
But to close out Jacqueline's question, Ren, is it worth it?
No.
No.
Like these are all perks to get people excited and to get people talking, but the amount of money you will make on or like save on any of these perks or discounts will be vastly outweighed by losing money if the actual company is bad.
Yeah.
We haven't come across a shareholder perk that should change the investment calculus.
No.
We've never seen something that's big enough that it's like, oh, you should factor that into the valuation.
Exactly.
Yeah.
Well, love the question, Jacqueline. Great way to close out the show. If you'd like to ask a question, we'd love to hear from you. There's a link in the show notes or description below for you to leave a voicemail. We really appreciate if you can leave us one. Or you can write us a question at equitymates.com/contact. Remember to join us in the Facebook discussion group. Follow us on Instagram. And if you love what we do and get a lot of value from it, then can you please leave a rating and a review in your podcast app? It goes a long way to helping us get in front of new Equity Mates listeners. But Ren, that brings us to the end. As always, a pleasure to chat stocks. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.